Welcome to the income arena, folks. All right. Welcome back to Mad Money, where we're always hunting for the next big winner. Tonight, we're diving headfirst into a battle of titans, a clash of income-generating giants. I'm talking about JEPI and JEPQ, two ETFs that have been setting Wall Street on fire with their promises of juicy dividends and solid performance. You've asked, and Cramer is here to deliver. We're gonna dissect these bad boys, lay them bare, and figure out which one might just be the ticket to padding your portfolio with some serious cash flow. So grab your notebooks, turn up the volume, because class is in session. This isn't just another boring financial lecture. This is about making money. Now, for those of you living under a rock, and I hope that's not many of you because rocks don't pay dividends, JEPI and JEPQ are what we call covered call ETFs, but with a twist. They're designed to give you, the hardworking investor, a steady stream of income month after month. Think of them as your portfolio's personal ATM, spitting out cash while still giving you a piece of the market action. JEPI, that's the JPMorgan Equity Premium Income ETF, generally dances with the S&P 500, and JEPQ, its sibling, the JPMorgan Nasdaq Equity Premium Income ETF, gets its groove on with the tech-heavy Nasdaq 100. Two different playgrounds, two slightly different ways to rake in the dough. These aren't your sleepy old-school dividend funds, folks. No sir. These ETFs are actively managed, meaning there are smart folks at JPMorgan trying to squeeze out every last drop of income potential for you. They use a combination of buying stocks and selling options, specifically through things called equity-linked notes or ELNs, to generate that sweet premium income. It sounds complicated, I know, but stick with Cramer. I'll break it down so even your cousin who thinks a stock is just something you put in soup can understand it. We're talking about a strategy that aims for lower volatility than the broader market while still delivering those income checks. Ka-ching! So why the hype? Why is everyone from Wall Street whales to retail warriors buzzing about JEPI and JEPQ? It's simple. In a world hungry for yield, these ETFs have been delivering the goods. They're offering a compelling proposition, especially for investors looking to supplement their income or navigate choppy market waters. But are they too good to be true? Are there hidden risks? Which one is the heavyweight champion for your specific needs? Don't you worry your little investing heads about it. We're going to put them through the mad money ringer, examine every angle, and by the end of this you'll know which one, if any, deserves a spot in your portfolio. Booyah! Alright, let's get down to brass tacks with JEPI. This is the JPMorgan Equity Premium Income ETF, ticker JEPI. Now what's its secret sauce? What makes it tick? JEPI's main game is to generate monthly income while keeping a lid on volatility. It does this by investing in a portfolio of US large-cap stocks, primarily those within the S&P 500, that the managers believe have attractive value and quality characteristics. Think solid, dependable companies, the kind that form the backbone of the American economy. These are the workhorses, not necessarily the flashy racehorses, but they get the job done. But here's where it gets interesting, folks. JEPI doesn't just buy and hold these stocks like some sleepy index fund. No, it actively manages its portfolio, and a significant chunk of its strategy involves using those equity-linked notes or ELNs that I mentioned earlier. These ELNs are where the magic happens for income generation. They are designed to replicate the returns of selling covered call options on the S&P 500 index. This means JEPI is essentially selling the right for someone else to buy the S&P 500 at a certain price, and for taking on that obligation, JEPI collects a premium. That premium, my friends, is a big part of your monthly dividend. The beauty of this ELN strategy when it works is that it can provide income even when the market is flat or moving sideways. It's like renting out a room in your market house. You get rent, the option premium, regardless of whether the overall property value skyrockets or just stays steady. Of course, there's a trade-off. By selling those calls, JEPI caps some of its upside potential. If the S&P 500 goes to the moon, JEPI might not capture all of that explosive growth because the stocks it rented out via the calls get called away. But for many income-focused investors, that's a trade they're willing to make for more consistent monthly paychecks. So, JEPI is aiming for a smoother ride. It's looking for companies with lower volatility than the broader market, and then it layers on that option strategy to generate income. The fund managers are constantly tweaking, constantly analyzing, trying to find that sweet spot between capturing some market upside and delivering that all-important income. They're looking for defensive characteristics in their stock selections. Think about it. Quality companies, a smart options overlay. It's a recipe designed for investors who want income without necessarily wanting to ride the full roller coaster of the market. It's about that steady, reliable drip of cash. Got it? Now let's shift gears and talk about JEPI's more aggressive, tech-savvy cousin, JEPQ. That's the JPMorgan Nasdaq Equity Premium Income ETF, ticker JEPQ. If JEPI is playing in the S&P 500 ballpark, JEPQ is stepping onto the high-flying field of the Nasdaq 100. We're talking about the innovators, the disruptors, the companies that are shaping the future. Think big tech, growth-oriented names that can really light up the scoreboard when they're on a roll. This immediately tells you that JEPQ might have a different risk-reward profile than its S&P 500 focused counterpart. It's built for a different kind of thrill. Just like JEPI, JEPQ's primary mission is to deliver that beautiful monthly income, but it does so by focusing on the Nasdaq 100 index. And yes, you guessed it, it also employs those sophisticated equity-linked notes, ELNs, that are structured to replicate the economic characteristics of a covered call strategy. So, JEPQ is buying a portfolio of Nasdaq 100 stocks, or stocks with similar characteristics, and then selling call options against the Nasdaq 100 index via these ELNs. It's the same fundamental income-generating mechanic as JEPI, but applied to a much more growth-oriented and often more volatile underlying index. KPOW. The key difference here, folks, is the playground. The Nasdaq 100 is known for its higher growth potential, but also its higher volatility compared to the S&P 500. This means that while JEPQ aims to provide income, its total return and its ride can be a bit more exciting. When tech is booming, JEPQ has the potential to capture more of that upside even with the covered call strategy. But when tech takes a tumble, JEPQ might feel that pain a bit more acutely than JEPI, even with the income cushion from the option premiums. It's a trade-off, always a trade-off in this game. So, JEPQ is for investors who want that income stream, but are also comfortable with the potentially bumpier ride that comes with Nasdaq 100 exposure. They want a piece of the tech action, the innovation, the companies that are changing the world. But they also want that monthly dividend check to smooth things out. The managers at JPMorgan are working their magic here too, selecting stocks and managing those ELNs to try and optimize that balance between growth and income within the Nasdaq universe. It's a high-wire act, but when it pays off, it can really pay off. Are you with me? Alright, let's pop the hood and really get greasy comparing these two income machines side by side. JEPI and JEPQ, while sharing a similar DNA in their income generation through ELNs and covered calls, are fundamentally targeting different segments of the market. JEPI, our S&P 500 specialist, is all about those established blue-chip American companies. We're talking about a broad diversification across various sectors: financials, healthcare, consumer staples, industrials. It's like a well-balanced meal designed for stability and consistent nourishment, or in this case, consistent income. The focus is on lower volatility stocks within this universe. JEPQ, on the other hand, is laser-focused on the Nasdaq 100. This means a heavy concentration in technology, communication services, and consumer discretionary sectors. These are the growth engines, the innovators, the companies that can deliver explosive returns but also experience sharper drawdowns. Think Apple, Microsoft, Amazon, Nvidia, the titans of tech. So, while JEPI is casting a wide net across the US economy, JEPQ is fishing in a more specialized, high-growth pond. This difference in underlying stock selection is absolutely critical to understanding their potential performance and risk profiles. Don't just look at the yield, folks, look at what's generating it. The core mechanism for income, those equity-linked notes mimicking covered calls, is the common thread. Both ETFs aim to collect premiums by selling call options on their respective benchmark indices, S&P 500 for JEPI, Nasdaq 100 for JEPQ. This strategy inherently limits upside potential. If the S&P 500 or Nasdaq 100 has a monster rally, JEPI and JEPQ will likely lag because the stocks they've written calls against will be called away, or the ELNs will cap the gains. However, in flat, choppy, or moderately rising markets, this strategy can shine, consistently churning out income when traditional buy-and-hold strategies might be treading water. It's about harvesting volatility, so the active management component is also key. The managers aren't just passively tracking an index and selling calls. No, They are selecting individual stocks for the equity portion of the portfolio. Up to 20% can be in these stocks, the rest in ELNs, and actively managing the option strategy reflected in the ELNs. For JEPI, they're looking for undervalued lower beta S&P 500 stocks. For JEPQ, they're applying a similar lens but to the Nasdaq universe. This active layer is JPMorgan's attempt to add alpha, to do better than a purely systematic covered call strategy. It's their secret sauce, their Wall Street wizardry at work for you. Booyah! Section 5, Performance Throwdown, JEPI's Steady Hand. Now let's talk Turkey. How has JEPI actually performed? Past performance is no guarantee of future results, you hear me say it all the time, but it gives us clues. It tells us how this strategy has navigated different market storms and sunny days. JEPI, with its focus on the S&P 500 and lower volatility stocks, is generally designed to be a smoother ride. Its goal isn't necessarily to knock the lights out in a raging bull market, but to provide a more consistent, less stomach-churning experience, while still delivering that income and some capital appreciation. Think of it as the trusty sedan of your portfolio, reliable, comfortable, gets you where you need to go. Looking back at its history, especially during periods of market chop or downturns, JEPI has often demonstrated its defensive qualities. When the broader market zigs and zags wildly, JEPI has tended to zag a little less, thanks to that income cushion from the option premiums and its more conservative stock selection. For example, during some of the more volatile patches we've seen in recent years, JEPI often held up better than a straight S&P 500 index fund on a total return basis, especially when you factor in those juicy monthly dividends being reinvested. That's the power of defensive equity combined with an options overlay, people. However, and this is a big however, in strong bull markets when the S&P 500 is rocketing skyward like a SpaceX Falcon Heavy, JEPI is likely to lag. That covered call strategy, the ELN selling calls on the S&P 500, means it gives up some of that massive upside. If the index runs up 30%, JEPI might only capture a portion of that gain in its price, though the dividends keep flowing. So, it's not going to be your go-to if you're trying to shoot the moon with pure capital appreciation. It's built for a different purpose: income and reduced volatility. Understand the trade-off. So, when you're looking at JEPI's performance, you have to consider the total return. That's capital appreciation plus those all-important dividends. And on that front, it has often delivered a compelling package for income-seeking investors. It aims to give you a decent slice of the market's upside, a significant income stream, and hopefully a little less gray hair during market corrections. It's about finding that balance, that sweet spot. For many folks, especially those in or nearing retirement, or those who just can't stomach wild swings, JEPI's track record offers a compelling argument for stability and income, steady as she goes. Section 6. Performance Throwdown, JEPQ's Growth Gambit. Alright, buckle up because now we're looking at JEPQ's performance and this is where things can get a bit more vibrant. JEPQ, tethered to the Nasdaq 100, is playing in a different league. We're talking about the growth darlings, the tech innovators, the companies that can deliver eye-popping returns but also experience some gut-wrenching drops. So when we look at JEPQ's scoreboard, we expect to see bigger swings, both up and down compared to its S&P 500 cousin JEPI. This isn't your grandpa's utility fund, folks. This is income generation with a growth kicker. When the Nasdaq 100 is on a tear, when tech is the undisputed king of the market, JEPQ has the potential to deliver some seriously impressive total returns. Even with the covered call strategy implemented through its ELNs, the sheer momentum of the underlying Nasdaq 100 stocks can help JEPQ post strong capital gains on top of its already attractive dividend yield. I've seen periods where JEPQ has significantly outperformed GPI on a total return basis, simply because the Nasdaq 100 was leaving the S&P 500 in the dust. That's the allure of hitching your wagon to those high-growth Nasdaq stars. Zoom! But, and you knew there was a but coming, didn't you? When the tech sector hits a rough patch, when those growth stocks fall out of favor, JEPQ can feel the pain more acutely. The Nasdaq 100 is inherently more volatile than the S&P 500. So if there's a tech wreck, JEPQ's price could fall faster and further than JEPI's, even with the income from the option premiums providing some cushion. The dividends will still likely flow, but the net asset value, the share price, could take a bigger hit. It's the price you pay for dancing with the high flyers. You gotta have the stomach for it. So, JEPQ's performance story is one of higher highs and potentially lower lows in terms of price movement compared to JEPI. The total return, when tech is leading, can be very compelling. It offers a way to get that Nasdaq 100 exposure, participate in the growth of innovative companies, and collect a hefty monthly income. But investors need to be prepared for more volatility. It's not a set it and forget it for the faint of heart during market corrections. It's for those who want income, but also want to keep their foot on the growth accelerator and are willing to handle a few more bumps in the road. Are you ready for that ride? Section 7. Dividend Deluge. The income stream comparison. Ka-ching. Now we're talking about the main event for many of you, the dividends. The sweet, sweet income that JEPI and JEPQ promise to deliver. This is where these ETFs really try to shine, aiming to provide a yield that can make traditional dividend stocks blush. Both JEPI and JEPQ are structured to pay out monthly distributions, which is fantastic for folks looking for regular cash flow to cover expenses or to reinvest systematically. That monthly paycheck from your portfolio, yes please, it's like getting a little bonus every 30 days. JEPI, drawing its income from options premiums on the S&P 500 and dividends from its underlying value-tilted stocks, has historically offered a very attractive yield. We're often talking about yields that are significantly higher than what you'd get from the S&P 500 index itself, or even from many traditional dividend-focused ETFs. The consistency of these payouts is a major draw. While the exact amount can fluctuate month to month based on market volatility, higher volatility often means higher option premiums. JEPI has built a reputation for being a reliable income generator. It's like a well-oiled income machine, steadily pumping out cash. Now, let's look at JEPQ. Given that the Nasdaq 100 typically has more inherent volatility than the S&P 500, the option premiums JEPQ can generate from its ELN strategy on the Nasdaq 100 can sometimes be even higher than what JEPI generates on the S&P 500. This means JEPQ often sports a dividend yield that can be, at times, eye-poppingly large, potentially even juicier than JEPI's. If you're purely chasing the highest possible monthly income stream from this type of strategy, JEPQ might often flash a more seductive number. More risk in the underlying index can mean more premium for selling those calls. However, it's crucial to remember that a higher yield doesn't always mean a better total return or a safer investment. JEPQ's higher potential yield comes with that higher Nasdaq 100 volatility. The source of the dividends is primarily from those option premiums. While the underlying stocks in JEPQ, tech and growth names, aren't typically known for massive dividends themselves, the option strategy is the workhorse here. So both ETFs are fantastic income tools, but JEPI's income might feel a bit more stable due to its less volatile underlying index, while JEPQ might offer a higher but potentially more variable payout with greater NAV fluctuations. It's a feast of dividends, folks, but choose your plate wisely. Section 8. Weighing the options, pros and cons, Mad Money style. Alright, let's lay it all out on the table, no punches pulled. Every investment has its good sides and its not so good sides, and JEPI and JEPQ are no exceptions. Let's start with JEPI, the S&P 500 income specialist. Pro number 1, that consistent monthly income. Booyah! It's designed to be a cash flow machine. Pro number 2, lower volatility compared to the broader S&P 500, and certainly compared to JEPQ. That can mean a smoother ride, which is music to the ears of many conservative investors or retirees. Pro number 3, active management by seasoned pros at JPMorgan, trying to optimize both stock selection and the option strategy. But JEPI isn't perfect, folks. Con number 1, capped upside potential. In a rip-roaring bull market, JEPI will likely underperform a straight S&P 500 index fund because those covered calls via ELNs limit how much it can capture of the big gains. You're trading some growth for that income. Con number 2, while it aims for lower volatility, it's still invested in equities, so it's not immune to market downturns. The price can still go down. Con number 3, the income can fluctuate. While generally consistent, the exact monthly payout can vary depending on market conditions and the premiums generated. Don't expect the exact same check every single month down to the penny. Now let's flip to JEPQ, the Nasdaq income rocket. Pro number 1, potentially higher income. That Nasdaq 100 volatility can translate into fatter option premiums, meaning JEPQ can sometimes sport an even higher yield than JEPI. Ka-ching! Pro number 2, exposure to the growth potential of the Nasdaq 100. You get income plus a ticket to the tech and innovation party. Pro number 3. Like JEPI, active management trying to squeeze out the best risk-adjusted returns from that specific universe. These managers are working for you, but hold your horses. JPQ has its own set of caveats. Con number 1, higher volatility. The Nasdaq 100 is a wilder beast than the S&P 500. That means JPQ's price can swing more dramatically, both up and down. You need a stronger stomach for this one. Con number 2, significant sector concentration. It's heavily tilted towards technology and growth. If those sectors hit a wall, JPQ will feel it hard. Diversification is less broad here. Con number 3, just like JEPI, it is capped upside potential due to the covered call strategy. If the Nasdaq 100 truly goes parabolic, JPQ will capture some but not all of that explosive move. It's the nature of the beast. Section 9, the final verdict. Which ETF gets the Cramer crown? Alright folks, the moment of truth. After all this deep diving, all this analysis, which ETF, JEPI or JEPQ gets the coveted Cramer crown? Which one should you be considering for your hard-earned money? Well, as much as I love to pick a winner, the answer, as it so often is in the complex world of investing, is... it depends. It depends on you, your risk tolerance, your income needs, and your overall investment goals. These are both powerful tools, but they are designed for slightly different jobs and different types of investors. There's no one-size-fits-all here. If you are an investor who prioritizes capital preservation, desires a smoother ride, and is looking for a consistent, respectable monthly income stream primarily from more stable, blue-chip US companies, then JEPI is likely your champion. It's built for those who want to dial down the portfolio volatility, sleep a little better at night during market squalls, and still get a nice paycheck from their investments. Think retirees, income-focused investors who are a bit more risk-averse, or anyone looking to add a defensive income component to their broader portfolio. JEPI is your steady hand, your reliable workhorse. Buy if that's your profile. However, if you're an investor with a bit more appetite for risk, if you want to tap into the higher growth potential of the Nasdaq 100, and you're comfortable with more significant price swings in exchange for a potentially higher dividend yield and more capital appreciation upside during tech rallies, then JEPQ might be screaming your name. This is for the investor who says, give me that income, but I also want a piece of that Nasdaq action. You understand that with greater growth potential comes greater volatility, and you're okay with that trade-off. JEPQ is your growth-oriented income play, your high-octane option. It's for those who can handle the heat. Ultimately, some investors might even consider a combination of both. Why not get the best of both worlds? A little S&P 500 stability from JPI, a little Nasdaq growth kick from JPQ. Diversify your income streams. The most important thing is to do your homework. Understand what these ETFs are, how they work, and how they fit into your personal financial plan. Don't just chase yield blindly. Look under the hood, assess the risks, and make an informed decision. And remember, the market is always changing, so keep learning, keep adapting, and keep fighting for those returns. Booyah! Now go make some money.